Most people saw the number this week and immediately dismissed it. $3,947 per ounce of silver. It sounds extreme. It sounds like internet hype. It sounds like something you scroll past. But here's the part almost nobody is actually looking at. When you strip away the sensational target, when you rebuild the math from scratch, and when you deliberately make every assumption conservative, silver still does not come out at $84. That's the real story. Not the headline number. The math underneath it. Today is Sunday, February 22nd, 2026. Markets are closed, but Friday's close matters. Silver finished at $84.52. Gold closed at $5,115.90. The Dow is sitting near 49,500. Most investors see price action, professionals watch ratios, and right now, 3 long-term ratios are telling the same story. Start with the foundation, debt and gold. During World War II, the United States backed roughly 51% of federal debt with gold reserves. Today, that number is closer to 3%. The gold in the vaults didn't disappear. The debt simply exploded around it. If U.S. gold reserves were revalued to back even a modest percentage of current federal debt, not 51%, not 25%, but even 10%, gold doesn't stay anywhere near $5,000. The arithmetic forces it higher, and when gold reprices in a debt-driven cycle, silver historically does not stay behind. Then, look at the Dow-to-Gold ratio. This is a 100-year relationship between stocks and gold. When the ratio is high, stocks are expensive relative to gold. When it is low, gold is expensive relative to stocks. The ratio peaked in 1929, peaked again in 1966, and reached an extreme in 1999, near 45. Each time, gold went on to massively outperform stocks. Today, we're around 9 to 10, roughly where the ratio sat in the early 1970s before gold moved from $180 to $850. If that ratio compresses again, and historically it always has, gold must rise substantially even if the stock market doesn't collapse. Now apply moderate assumptions. Not extreme ones. If the Dow-to-Gold ratio moves toward the middle of prior cycle lows instead of the absolute bottom, gold still lands deep into 5 figures, and whenever gold makes that kind of move, silver historically outperforms during the compression phase, which brings us to the gold-to-silver ratio. Right now, 1 ounce of gold buys about 60 ounces of silver. In prior bull markets, that ratio compressed sharply. In 2011, it reached 31. In 1980, it fell to 14. Even before the 1980 blow-off, it traded in the 30 to 35 range. So, don't use 14, don't even use 19, use 35. If gold reaches $15,000 in a conservative debt adjustment scenario, silver at a 35 ratio is over $400. That's not hype math, that's historically grounded ratio behavior. Now, let's address the pushback. Yes, higher prices incentivize mining, but new silver mines take 7 to 10 years from discovery to production. Expanding existing operations takes several years. Demand shocks driven by monetary repricing happen in months. In the 1970s, mining output increased significantly, and prices still went vertical. Timing matters. Supply response lags, macro repricing. It's also true that silver is not held by central banks the way gold is. But silver today is listed as a critical mineral in the United States. It is essential to solar infrastructure, semiconductors, defense systems, electric grids, and advanced electronics. It doesn't need to be a reserve asset to matter. It needs to be scarce and indispensable. It is both. The real question isn't whether silver hits $3,147. That would require aggressive assumptions and extreme ratio compression. The more important question is whether you can mathematically keep silver under $400 if the Dow-to-Gold ratio continues reverting. Gold reprices relative to debt, and the gold-to-silver ratio compresses to historically normal bull market levels. I tried to build the most conservative version of that framework possible, and silver still clears $400. That's roughly 5 times Friday's close of $84.52. This isn't about next week, it's about a multi-year cycle. Historically, these ratio compressions unfold over 5 to 7 years. The 1970s cycle took about 7 years from the early compression phase to the peak. If we are in a similar structural phase now, the major repricing is still ahead, not behind. What matters going forward is simple. Watch the Dow-to-Gold ratio. Watch whether it continues trending lower. Watch the gold-to-silver ratio and see if it breaks decisively below 50. Watch physical market stress, vault withdrawals, refinery backlogs, rising premiums, and pay attention to any policy moves involving strategic silver stockpiles. Here's the final thought that ties it together. The total investable silver market is tiny relative to global debt. When even a small percentage of capital seeks refuge in hard assets, price adjustments are not linear. They are non-linear and often violent. That's not speculation. That's how small markets behave when large capital flows hit them. $84 silver feels high compared to where it was. But through the lens of historical ratios and debt mathematics, it may not be late. It may still be early.